Okay, thanks very much for everybody for coming. So my job as the academic moderator is to pull everything together for you. So we've seen, if you'd like, we have the trees, and I'm going to try and give you the forest. And I'll try and give some suggestions for improving the papers as well. But I think the basic underlying thing I want you to find out is that these are really great papers. They actually follow a common theme, even though it may not have been obvious when you saw the papers. And they really push the research forward. So let me go on with that. Okay, so just to briefly remind you, I'm not going to go over the papers again because you just heard them. The Frank paper talks about community bank profitability over time and with different regulatory periods. The Marsh-Sengupta paper tells us about competition as proxied by geographic deregulation on the risks of community banks and regional banks. And the Ballou, Iceland, and Nicoletti paper talks about the effect of Dodd-Frank regulation on bank M&A activity. So you might think, well, maybe the theme is regulation and bank performance. And that is true. But in fact, there's actually a bigger theme here that this is part of. And this bigger theme is the one that these papers are really pushing forward. And the bigger theme is bank competition and performance. So when we think about regulation, regulation is part of bank competition. In fact, regulatory treatment often affects competition between the banks, and this is the theme that I would like to push. Sometimes it determines which banks can compete with each other, and sometimes we have regulations that tell us that that banks over a certain size have different rules than those undersized class. All three of the papers look at these differential effects of regulation by size. The first paper looks at different regulatory time periods for community banks. The second looks at the effects of geographic deregulation of community and regional banks. And the third paper looks at the Dodd-Frank bright line for banks over and under that line. So all of these papers also look at very important topics that are in this literature on bank competition performance. They're going to look at profitability, risk, and M&A performance. So these fit right into that literature. They may not realize it's in the literature, but that's what it is. Okay, now all three papers push the envelope in three dimensions that I'm not sure that they realize it, but these really do something good. So most of the literature on competition using US data focuses on the deposit HHI index or Herfindahl-Hirschman index and not on other things. And that's a big mistake in the literature. None of these papers fall into that trap. That's great. There are some other papers that use regulation over the last 20 years as measure of competition, but mostly they look at the economy in the local area and they don't look at bank performance. So these three papers also look at bank performance, a big step forward. And then finally, most papers, you're not going to believe this, but most papers in the literature assume that competition is the same by banks of all sizes. I mean, we're at a community bank conference. We all know that that's not true. If we thought that was true, we would be at a bank conference, not a community bank conference. So you'll see as we go along that these papers do a big service by looking at banks differentiated by bank size. Okay, so let me give you some background, and I'll spend a few minutes on this, on bank competition and performance research. There are hundreds, if not thousands, of papers since 1963, and you'll see why I picked 1963 in a moment, that look at the effect of bank competition on performance. In most cases, they use this deposit Herfindahl-Hirschman index, which I'll tell you what that is in just a moment, that's supposed to reflect competitive conditions for all banks of all sizes and in all dimensions. So it's a terrible way to do research, and I'll tell you the reason for it in a minute. It is terrible. I use it too, but it's terrible. Okay, so the Herfindahl-Hirschman index is the sum of squares of market shares, and it's only based on deposits. Now, in an ideal world, if we had what's called Cournot quantity competition, this would be perfect, but we don't live in that world. Also, bank competition is assumed to be independent of bank size. Does anyone think community banks and large banks compete the same way? They don't. But yet almost all the competition research assumes that they do. Now, why is that? Well, we had an antitrust case in 1963 called United States versus Philadelphia National Bank, and the Supreme Court decided that banks competed on the basis of clusters of local products. So if all competition is local and all competition is similar based upon all the products, all you need to do is collect the competition measure for local deposits, and you're done. So that's what was done. So under the cluster approach, you only need to collect bank deposit location, and unfortunately for research, the regulators don't really collect data for research purposes. They really collect it for regulatory purposes, and that's what the researchers are stuck with. So they're stuck with this FDIC summary of deposits, which collects location data on bank branches and deposits, but on nothing else. So that's what we've been using for the last 54 years. Okay, now there are some papers over the last 20 years that have started using regulatory data to measure competition. So they mostly look at the deregulation, interstate and intrastate deregulation to see what's the effect on the local economy. Now, ideally, you would like to have them know what's the effect on bank performance, but they kind of go around that and just look at the performance of the economy. So they look and see the state outcomes like state income growth, performance of non-financial firms and households. I mentioned these two names at the bottom, Philip Strawn. He wrote about half of these papers and most of the good ones. And Tara Rice is responsible for this Rice and Strawn index, which got mentioned in Blake's paper. So now what's wrong with this literature? Well, deregulation is an indirect measure of competition, not how banks compete, but how the states allow the banks to compete. I still like this. But the real economic outcomes, the state income and so forth, are not measures of bank performance. They're indirect measures of bank performance. And what all three papers do is they look at the actual bank performance. This is a big step forward. Okay, now they also look at differences in behavior by bank size. Now, this might sound like obvious that we should be doing this, but it wasn't always obvious in the research literature. Until about the last 15 years or so, everybody just kind of thought of banks as one thing and didn't realize that large banks and community banks are very different. The large banks have advantages in using hard numbers like credit scoring, and the small banks or community banks have advantages in doing things like relationship lending with soft information. I know this is all obvious to the community bankers here, but this was not obvious to the research literature until about 15 or 20 years ago. Now, the research has even lagged that. It's only in the last 10 years or so that there's been any research that looks at the effects of, let's say, community bank presence on economic outcomes like the small business lending. Only the last 10 years. And you'll see there the list of names. It's a very limited set of names. They're all my papers. In fact, I presented a paper here 2 years ago, for those of you here 2 years ago, that was a little bit better than the previous ones, that actually had a measure of small business satisfaction with their finances, and showed that the more community banks were in the market, the more was the satisfaction of the customers. They were having their financial constraints relieved, and unfortunately that paper is forthcoming in a journal now. So what do these three papers in the session have to do with it? They all extend this research by looking at bank competition on the performance of banks in particular size classes. I'm telling you, this is a new topic. It seems like an obvious topic to do, but it's a relatively new topic that hadn't been done much. Okay, how can we improve the papers? Well, I have some general suggestions. First of all, I would suggest all three of the papers try and broaden the appeal of the papers by putting them in this larger context of bank competition and performance. You can contribute much more to the literature if you put yourself in a broader context. And then I would emphasize the three advantages that you have over most of the literature. Using regulation instead of the deposit market HHI. Using direct measure of bank performance instead of indirect measure of the local economic performance. And looking at the differences by bank size. And I've given you some context there, and you can all have a copy of my slides if you'd like. Okay, now some specific, now guys don't get off scot-free. I get to criticize you and tell you some things that you should be doing. So you knew that was coming. So for Jared's paper, I would add a table with the variable definition summary statistics. It was sometimes difficult to figure out exactly what all the variables were. You focus on one measure of profitability, but I'd like to see more measures of profitability and performance. Why not also include the local deposit HHI as an alternative measure and see what effect that has? You could also consider, following Blake's example, and put in the Rice and Strachan index in there and see what effect that has. That's an index of the even after the Regal-Neal Act, some of the states have additional restrictions on entry from out-of-state banks. They could include that. Now, this analysis is totally on community banks. Well, if we want to see what's special about community banks, let's do the same thing for the larger banks and see what the differences are. I think that would be good. And then the last thing is I would double check which banks are included. I'm not sure what your definition of banks is. Maybe you're including the thrifts or something. But okay, yeah, because it has more banks in there than there are banks. But there are commercial banks. But just make that a little clearer. Okay. All right. How about for Blake's paper? You stop in 2005. That I understand that the reason for that, and that's because Rice and Straughan's paper stops in 2005 and they stop providing the index. But you can go further than that. You can go to the state regulators and find out what the index is more recently, and that's very possible to do. The tables are not labeled very clearly. I can't always tell what's the independent variable, what's the dependent variable. You label the columns by the independent variable instead of the dependent variable. I'm sure that's just because you were kind of rushed to get it out. You include in there the lagged loan growth. I don't care for the practice of including the same variable to explain itself in the past. I'd rather see if it works without that in there. Now, also, you focus on the loan growth, the CRE loan growth, and I understand that's a good measure of risk. But I'd like to see some other measures of bank risk, like Bank Kaplan Z-score. It turns out that they're testing these opposing theories about whether competition increases bank risk or decreases bank risk. It turns out that the theories are not mutually exclusive. It turns out multiple theories can be true at the same time. I have a paper, not that I want to advertise my own research, but I do. A few years ago that finds that actually competition leads to riskier loan portfolios, as the Boyd-DiNiccolo theory says it should, but it also leads to safer banks, as the Keeley theory says it should, because the banks more than offset that additional portfolio risk with higher capital. So multiple theories could be true, and you could check this also. Finally, specific suggestions for Allison's paper. I didn't quite understand why banks below the $10 billion should be lumped in with those above $10 billion. Maybe it's that they think they're going to go over $10 billion organically, and so they might as well jump further. But just clarify what that is. I think it's okay, but and I would try the test for just above and just below $10 billion, make sure that that's true. Sometimes you use $8 billion, sometimes you use $9 billion. I would just pick a consistent number. And then finally, just a technical point, you sometimes use one-sided tests. And the theories can go both ways, so I would always do two-sided. So I just wrap up and say, these papers are really quite good. They really push the literature. They don't realize how good they are. They don't realize they're in this bigger literature, but now I hope they do. And I encourage you to read the papers and enjoy them. And with that, I'm going to ask the authors, I'm going to give the authors a minute or two to see if they want to respond to Kevin's comments and my comments, and then we'll turn it over for questions. So be thinking of your questions, and when I call on you, say your name and affiliation, and speak loudly and clearly into the microphone. So why don't you go ahead, sir.
Great, thanks. Alan, I hope you'll forgive me. Your comments are very useful, but I feel like I need to write them into a new paper. I mean, like I need to extend the paper. One thing I did want to pull out was something that Kevin mentioned. And it's something I would never feel comfortable saying. I'm only 2 years out of my PhD program and have no heft with y'all yet. But basically during those high years, when in my graph I was able to show that the core profitability was trending downwards, he described it as people getting lazy, right? Like you have these really great years and it's easy to think they're gonna stay that way, so you might let things slip up even without realizing it. Or competitors enter in who aren't really up to snuff. And that's one thing that this recession did, despite how awful it was, is that it cut out a lot of the chaff, and I think it also made a lot of bankers reevaluate their business models to change what product lines they were focusing on and really bear down on trying to eke out that little bit of extra profit that they could, right? You got much tighter ships because of that recession, which is shown in the graph by this rising trend in core profitability following that, which is actually the great news that was excited to see in the paper, that core profitability is on the rise and that it's rising faster than it has any time in this 30-year period that I'm looking at. It actually seems to indicate that community banks are doing better than they've ever done, despite a really tough economy. And that if things continue as they are and the economy continues to improve, community banks can look forward to potentially another great heyday. And that's something to be excited about.
Okay, so thank you for the comments. Yeah, I'm going to address Kevin's comments first. So it's nice to sort of hear that what we see in the data is, the experience, I guess, that was realized. And I guess want to be clear, I guess, that the paper isn't really, I'm coming from a regulatory side, so my interest wasn't explaining why CRE concentrations increased over this period. And certainly this was an issue coming into the crisis because of the guidance that came out. And so I just want to make it clear that, it's not about not being able to compete against large banks. I think smaller community banks, regional banks, there are factors outside of their control. So I mentioned too big to fail subsidies and funding, and there are well-known issues, I think, that are outside of the control of community banks that allow large banks advantages. But that being said, I guess I haven't thought about it. One thing the paper does highlight is that these soft information channels are important to community banks. So I appreciate that giving us that insight. To Alan's comments, yeah, we'll put them all in and we'll work through them and maybe we'll end up with another paper. One thing that I guess you did address was we stopped in 2005. So the main reason for stopping in 2005 was actually because of the guidance. So the guidance comes out in early 2006. And there's a paper Bill Bassett and I have, which is one of those that we had earlier in an earlier conference here, that shows that had some growth rate effects. And so we knew the dynamics changed after that. The M&A activity slows down, the deregulation activity stops. So it's just a whole different regime post-2005. So.
Okay, well, so thank you to both Kevin and Alan for your comments. So Kevin, so it sounds like your community bank acquisition that you just had is like a perfect case study for our paper. So I'm really interested to talk to you about that a little bit more. In particular, one of the things that you had highlighted was that most of the costs seem to be coming from the Durbin Amendment and not necessarily on the stress testing and CFPB. So that's something that I think we're becoming more aware of as we've talked to more bankers. So we're just trying to figure out what's the mechanism then that would be actually driving the acquisition. So is it more of a fixed cost issue still, or what would that be? So I'm interested to talk with you about that more. And then Alan, so obviously great points. We can do a lot of sensitivity on the different thresholds that we're using. As far as having the 9 billion to 10 billion in there with the 10 to 12 as well. So it's kind of, again, I can point to, I guess, Kevin's acquisition is a perfect example of that. So we're thinking that there's banks that are in the $9 to $10 billion range that are preparing to cross the threshold. So all we're trying to capture in that treatment group is just banks that are going to be largely affected by the costs that have incentives to engage in the acquisition. But we've done some sensitivity and just looked at 10 to 12, and the results still hold. So, but we'll get all of that into the paper. So thank you.
And so maybe that suggests that maybe maybe next year's case competition should be at Kevin's bank. Because Allison's paper putting it in practice.